Welcome to the daily update, where I'll go over the action in the market for Tuesday, September 10th, and then we'll see how things look for Wednesday, September 11th, a very sad day in American history. So, the market seems a little bit happier. We'll see how things unfold on Wednesday, but we're still looking negative for the most part, even though we've had 2 days of upward movement. Even when we're going up or down, we don't go in a straight line. But it's been kind of interesting seeing where weakness seems to be right under the surface, but it doesn't come into the market. And then some buying comes in, and it's actually producing kind of a mix in some of our indicators right now. And we don't have anything overbought or oversold at this time, which is very strange. I take that back. The 200-day simple moving average is still looking rather extreme, which could also suggest good momentum. But it looked like the market was getting ready to fall off a cliff on Tuesday. No, we went right down to support and we're able to bounce up off of that. We're a little bit above average with volume, but there's real anticipation ahead of CPI coming out on Wednesday, and we'll see how the market reacts to that. As I started recording this, the futures are down about 1/3% or so. We'll see if that carries over as we get closer to the open here. And then what will the reaction to CPI end up being here? So I have a program called the SPXInvesting Program. There's a link below this video that'll take you to the website or to a video. You also get early access to all the videos that I post. The daily videos, the real foundation of the analysis that I do. So let's go back and talk about what happened. We did have a gap higher, and the futures were just kind of chopping their way higher throughout the night. And that led to a higher open right at R1 at 54.92. But then right after that, we declined down below the unchanged level and the daily pivot. And at least in Tuesday's session, the daily pivot was very critical. We tested that like 5 times before we actually broke down below it. But the daily pivot was at 54.63. Then prices fell below the daily pivot and found support at S1. So after that testing time, we broke below, but we didn't really pick up some steam as far as selling is concerned. We went down to S1 at 54.42, and then we rebounded back up above the daily pivot, the unchanged level, and we closed back at about R1. So we kind of closed about where we opened in Tuesday's session. We were up 0.45% on just slightly above average volume. So we're still negative in the short and intermediate term, but we're seeing signs of an improvement instead of more confirmation with a lot of our charts showing that we're negative. We're seeing some of them turn back and look a little more positive. We didn't see that after Monday, even with the solid advance. Things still remain negative. We're still negative now, but the charts are picking up some of this buying that's coming in. And Wednesday will be big about inflation, and that will also have an impact on interest rates. With CPI coming out, we'll have PPI on Thursday, and those are big reports, especially CPI. That'll be the big one. And then all the different geopolitical things going on here. So banks and financial sectors, they were weak in Tuesday's session. Some news came out and it really took that whole sector down. It's still very positive overall, especially the financial sector. And I'll show you that chart here in just a little while. But they saw a bit of a pullback coming here. Oil is continuing to drop. We're down around the $65 level now. We've been watching this as it was into the 70s to see if it really shoots up because of geopolitical events. Well, there are geopolitical events, but oil is not necessarily reacting to that. The VIX is still under 20. We had become above 20 there for a few days. We dropped down below that in Monday and Tuesday's sessions. And then this mass index, I'm not showing that chart anymore. So much time has passed now that I think the validity of that signal, it kind of signaled when we had the big down time last week. I think that's pretty much passed now. Now we could still pick up and go down, but it's not necessarily what we're seeing in the mass index. And then we do have this initial Hindenburg omen that was triggered last week. There's not a confirmation yet, and we have to wait until October 3rd to see if there's another confirmation signal. We don't have anything in the short term that's oversold. We don't have anything in the intermediate term that's overbought. Long term, we're looking at the 200-day simple moving average, as I mentioned before. And this is very strange. Usually this list has something on it. And so it's really peculiar to not have anything coming up right now. And we'll see if the scenario ends up changing after CPI. It's all about the Fed cutting rates on September 18th. Is it going to be 25 basis points or 50 basis points? The dollar was down and interest rates were down. We just keep falling with that 10-year yield. We're at 3.65%, where after Tuesday, we were at 3.7%. And we're still inverted with the 10 to the 3-month. We're still uninverted with the 10 to the 2, and I'll show you that chart as well. Sentiment, though, ticked down. Even though we had an update with the S&P, we went from 42 down to 40. Could be some hedging coming into the market ahead of CPI. So you can come up with all kinds of reasons as to why sentiment goes up and down. We are starting to see a trend, though. We are now trending. The intermediate term ADX chart has now crossed above 20. What's really interesting, though, is the short-term chart is still below 20. Usually the short-term chart leads the intermediate term chart, but we are negative. The red line is still on top. And with the update, our bias is positive, and I've changed our momentum now to mixed. I mean, you can't really have two up days and not look a little bit more positive, even though the backdrop is still remaining more negative. That's why I'm keeping it mixed right now. So we just had the NFIB Small Business Optimism Survey. This came in lower than last time at 91.2, where in the previous reading it was 93.7. And here's a chart of that showing how optimism had been really rising, and then it really dropped off in the latest reading. And then here is the overbought, oversold composite. We're really dropping down. We're getting into the neutral area now. We're in the 46 range here. And that's kind of lining up more with the sentiment gauges that we follow. The S&P 500 level and then earnings per share, where they are still anticipating, at least Goldman Sachs is, that earnings per share will continue to rise. And that ultimately is what drives stock prices. And if they're going up, then they also see us being around the 5,600 or so by the end of 2024. The equity positioning as of late is going back up. It's still above zero. So folks are still getting into things. We're not seeing an awful lot of selling, but they're not necessarily extreme positive either. And then the mega caps and the tech positioning, we're seeing some money coming out of there right now. But over the last day or two, we've seen that show some improvement. And then the Magnificent Seven weighting, it's really dropped off now. And what we're seeing, and I've been trying to point this out in the daily videos, is the S&P 500 is made up of 503 stocks. And a lot of the gains that we've been seeing in the S&P have been by these Magnificent Seven stocks. Well, they're kind of going back a little bit here and actually coming down as far as their weighting. And it's the rest of the S&P that has been showing some improvement. And we're seeing that confirmed also by the NYSE is holding up. And that's another broad market measure that we look at as well. And then the 2-year yield, and it lends to a lead. It leads the Fed funds by 5 months. I'm not a big believer in all this stuff here, but take this for what it is. And they're really showing that the 2-year yield is coming down. That's what we're seeing in our charts too, where the Fed has yet to start lowering rates. And then the ISM correlated with payrolls over the past 70 years, where we're seeing the ISM really dropping down, and it's below 50. So that's showing a contraction where we're coming down, even with the revised number of jobs that we're seeing last week. If this continues to fall, this light blue line will also likely continue to fall as well, and that would be more negative for the economy. It's the employment area that we're really watching right now to see if that shows weakness. That could suggest that the market or that the economy is going into a recession. It's been holding up, at least for right now. And then these are earnings per share revisions. The focus here is we're taking this on a global basis. We look at the dark blue line here. And this is very common where they tend to revise these things down, because when you're looking out into the future, you can come up with pretty much any number you want and justify it. Well, then as it gets closer and closer and closer to when that number actually becomes the quarterly report for earnings, you kind of have to whittle it down, and usually it's revising things down a bit. Where we're seeing kind of just the opposite here in different areas, but typically that's what we see, is things will come down slightly as we get closer. And the worst inventory destocking cycle is likely behind us. This is where we saw this reading very low, and it's been going back up now. And this is just showing retail sales, and sales in general are showing an improvement. Then one chart that's kind of interesting here, I just found this. I don't know who posted this, and I don't follow the person that did. It flew by my feed. We're looking at, okay, what kind of scenario are we looking at right now? And this is what we look at all the time. And you can come up with all these lines and everything, whatever you desire to do. But are we more likely to break back to the upside? Now, our charts are not confirming that, at least now. Our charts would suggest that we could see some more decline here. We have weak seasonality, not so much in the first part of September, but in the latter part. But we're just not seeing that yet. We've had 2 up days now with the S&P 500, and similar to what we might have seen near the end of July going into the first part of August. Now, we don't know how this will outplay. People try to guess this. Outplay, play out. But of course, everyone tries to guess what they think is going to happen, but we just have to look at the actual facts that we have in front of us right now and then evaluate that. This is kind of interesting, and this is not a chart that I've been able to replicate. It's a risk management analysis put out by Real Investment Advice, and the main person there is Lance Roberts. This is the chart below. Well, over here it's on the side. It matches intermediate and longer-term weekly MACD signals to the markets. When both signals are on buy signals, that's more positive. And you can see we've been going up since the latter part of 2022 when we hit the bottom there. Well, you see how we're starting to roll over now, and that could be longer term negative. So when both signals confirm a sell, as in early 2022, the market has gone through a correctional phase. We'll just watch these things. Right now, the weakness that we're seeing just looks like a pullback, and we're not even into a decline phase yet. Now that could change at any time. What we'll be watching for is some kind of a significant decline on an increase in volume. All right, here is our chart. Where we did gap higher, the futures had been rather strong, but we got right up to R1. Then we fell down and we just kept bouncing off of this daily pivot. Finally, we broke through it. And I even posted something on the website saying it looks like we're breaking through this pivot point. There's a potential that selling could really pick up in intensity. No, we just went right down to S1. We stayed there for a little while, and then we're able to bounce back up above the daily pivot, the unchanged level, and come pretty much right back to the R1 level. So, and over here, this lighter area, the lighter green or blue here, this is where we saw the futures really starting to improve, and then that was carried over into the cash session. This is still a concern to us with the red line above the blue line. We're seeing value outperforming growth on an intraday basis. Seeing a little bit of improvement here with S&P growth to value intraday, where we have been declining overall. And then our end of day charts where growth was up, and that's really what held the market together. Even when we were looking more negative, growth was still hanging on to being positive, where value was down. So this is more positive, but we need to see more follow through with this. And growth was down, but down much less for the mid caps, but down more for the small caps. So we're seeing a little bit of improvement here with small cap growth to value at the end of day chart, a bit of a tick up with the mid cap growth to value, and a little bit of improvement here, but not any real trend is happening with S&P growth to value. Turning back up a little bit, but still below the rainbow when we compare the growth ETF with the value ETF. And discretionary to staples ticking back up, but it's been weaker lately overall. And large cap growth coming back and reclaiming its 100-day moving average. And our trend, we still have the red line on top, so we default to negative, but it is declining. The green line is turning up back just a little bit, but we're just barely above 20 now with the ADX, and we're crossing back above the moving average. So this could be taken as a confirmed negative trend that is actually strengthening. But you see here with the short-term ADX, we're still just a little bit below 20, even though the trend is getting a little bit stronger and it's also negative. Picking up a little bit right around average now with the volume oscillator. And we want to keep an eye on this. It's mainly the next chart after this. When this is going down, that means there's more fear when we look at the spread between risky and not as risky bonds here. And it ticked back up just a little bit, but this going down is a little bit of a concern to us that we're keeping an eye on. The Ulcer Index is showing that there's an increase of fear. We're above the moving average, but we're declining back below 20 with the VIX on the line chart as well as the bar chart. And the VIX of the VIX is also dropping as well. But the momentum for the VIX continues to be up, although the MACD is starting to roll over now. And here's the seasonal pattern of the VIX that we totally broke away from that when we had that big decline early in August. We'll see if we're going to come back and start matching up with that a little more. And we declined a little bit with this fear gauge, and we ticked up just a little bit here with this other fear gauge. So there's a little bit of contradiction there. And ticking back up here to the risk on to risk off ratio, but overall, we still continue to decline with this. And when we look at large caps versus small caps and take a ratio, the large caps have been outperforming as small caps appear to be under more weakness right now. We ticked up a little bit with the daily equity put call chart, so we're starting to turn over just a little bit with the 5-day, but we're continuing to go up with the 10-day. Volatility risk premium came down just a little bit, but we're in this band. We're not really seeing an extreme reading currently. And tick back up, but not back above this previous high here with the advanced decline line based on price, but we're above an advancing moving average. Also saw it's pretty much flat here. I guess both of these were pretty much flat, but still looking positive in the bigger picture when we compare the advanced decline line based on price and volume. Okay, saw an expansion new highs when we were breaking out a little bit at the open and then going into the close, but our 5-day and our 10-day continue to go down, and we're above zero with the advanced decline ratio, so that's positive. And we're coming back and crossing a little bit more convincingly above zero here with the advanced decline line based on price. We had dropped below zero based on volume, but now we're crossing back above and looking more positive there. We're still getting a positive value when we take the new highs minus the new lows, and then down below is a 50-period moving average, even though this is ticking down a little bit. And we're no longer extreme positive with the 10-day average of the S&P 500 highs minus the lows. This had held in there for a while, but now it's starting to drop below the green line, suggesting the longer-term momentum is starting to wear off. And we're turning back a little more positive here with the accumulation distribution. We're starting to cross back above the red line here, the moving average, and the boom indicator is showing an improvement as well. Where we had been looking more negative with this, now it's switching back to slightly more positive. And the Chaikin money flow, after it had been declining, it's coming up, and we're starting to see the red line go back up. So that's actually turning positive as well. And the Chaikin oscillator, still negative, but coming back up. And it's negative because it's below zero. The vortex continues to be negative with the red line on top. And our S&P 500 advanced decline line for price on a cumulative basis, ticking back up a little bit, ticking back up here based on volume as well. And we're still hanging in there pretty good here with the S&P versus the NYSE advanced decline line. They're both going back up. And then we look at the NYSE here. We're still below the declining moving average when we look at the cumulative advanced decline line based on price. And then we are turning back up, and we're above an advancing moving average here with our regular NYSE advanced decline line. And this gives more justification to saying why the broader market is holding up better, because we're seeing the advanced decline line doing quite well. Also, this one ticking back up and still looking pretty solid here with this other NYSE advanced decline line. When we break it out based on common stock, ticking back up slightly based on price and volume. And then another broad market measure of a 5-period moving average of the highs minus the lows, coming down, but still above zero. And our advanced decline line studies, we're still above the moving average here with the NYSE common stock, the S&P just coming really near its moving average with the mid caps and still below its moving average with the small caps. So we're not back above the 50-day moving average, though, and that's what we're watching as potential overhead resistance. And even though we were above average with volume, it's just barely above average. We're pretty much sideways with the 20. We're still declining with the 50-period moving average and declining with the 200 of the moving averages here when they're measured against the S&P. We're still not showing much of an improvement with the condition of the 20-period trend here. We're still below the lines, and the lines continue to decline. We need to break up above those lines for this to turn more positive. And we're still below both the simple and exponential moving average based on 20 periods. And we're getting slightly above this anchored moving average again. We came down to this other blue anchored moving average, and we're able to bounce up off of that. Now we're regaining some of this level that had been lost. So that's actually showing some improvement. And we're no longer extreme negative with the Stochk RSI, the Williams percent R, the CCI 14 just barely dropping below minus 100. So that's no longer extreme. And we never did become extreme with the CCI 20. And this is really strange. We're not extreme with the stochastics. We're bouncing up in the short term, no longer extreme in the intermediate term. We're declining here in the long term, but it's not giving an extreme reading either. And the force index is still below zero, even though it is improving. And we're still below the midpoint here with our standard deviations chart. Tick down just a little bit, but we're above 50 with those stocks in the S&P above their 20-period moving average. Also ticking down, but positive with those above their 50-day moving average, 100-day moving average, and 200-day moving average. And we're still below zero with the balance of power, but we did tick up slightly. And we're still below both lines with the condition of our 50-period moving average study here. And I pointed this out in yesterday's video. We came right up to the 50-period exponential moving average. That's the blue line, and that acted as overhead resistance. At least that's where prices stopped on Monday. We were able to close a little bit above that, but we're still below the 50-period simple moving average, and that's what most folks use for a moving average. And we're still above the 100-period moving average. Just want to keep those in mind just in case we see more of a decline. So we're just kind of battling around this spaghetti mess here, below the 20s and 50s, but above the 100s. We're still negative according to the go, no-go system. And we're still seeing a declining midpoint here with our lowest low value. TTM squeeze is still negative, dark blue and declining. We're still negative with the ease of movement. And we're slowing down a little bit, but we're above the moving average when we look at the speed of how the S&P has been moving. That's what standard deviation measures, is speed, not necessarily direction. We're still flat with the Erin indicator. It's just been on vacation for a while and hasn't come back. We're still negative here with the S&P McClellan oscillator. We were flat and we're below zero. So we're continuing to decline with the summation index based on price and volume. We're still negative with the NYSE McClellan oscillator. We're below zero, so we continue to decline with the NYSE summation index based on price and volume. We're still negative, but ticking up slightly with the Swenlin trading oscillator based on price and volume. And our momentum is now switched over to full-blown negative. The PMO is negative. We're negative based on price and volume. Didn't see much of an improvement here with the PMOs that are rising. The buy signals are declining, and the PMOs above zero are also declining. And we've gone from being negative to neutral with the Elder's Impulse system for the S&P. We're still negative with the parabolic SAR with the dots on top. We're negative in the short term with the slope oscillator. We're negative with the MACD. It's below its moving average. So all of our different oscillators, and even the long-term ones, are crossing below their moving averages now. Pretty much neutral with the Sean trend meter. This is interesting. Okay, we're watching this kind of closely because this is a different kind of indicator. The bullish percent index, this measures the point and figure buy or sell signals in the S&P. We actually declined when the S&P ended up finishing higher. That's a bit of a negative divergence, but this indicator has actually been holding up quite well. When we saw a big downward move last week, this barely went down at all. That's more positive, a positive divergence, you could say. But since it did go down on an up day, that's a bit of a concern, but we're still positive since we're above 50 with this. So taken as a whole, this indicator is still positive. We're declining, but still above 50 with the NYSE bullish percent index. We're still negative with the NASDAQ 100 bullish percent index. The Copic curve is showing a decline. The money flow turning up, but still below 50. That's still negative. Turning up with the ultimate oscillator, but still below 50. That's also negative. Crossing back above the moving average with unbalanced volume. That's actually turning more positive. And the RSI based on 14, we're still just barely below 50, and we haven't come back up to 50 yet here. So the momentum has not really switched over to positive here based on a lot of different oscillators that we look at, including the RSI. This is also positive. We're back above this R2 level, and we've been able to get back above that. So longer term, that is positive there. And we're coming back just a little bit out of the Ichimoku cloud here. That could be positive. It's also positive with the blue line above the red line. It's really hard to see, but the green line is, it looks like it's still declining here. But when we look at our different trend type analysis with different charts, we see kind of a doji looking thing here. After being negative with the Heiken Ashi, we're negative with the Kegi chart since it's red, but it's pointing up. So that's more of a positive bias with a negative chart. The Renko is still negative, and the three-line break continues to be negative. Long term, we are getting above this red line here with the 200-day moving average. And we're still negative in the short term, according to the Keller market model, and we're negative in the intermediate term as well with the NASDAQ 100. We're also negative in the short term here with stocks, positive across the board with bonds, and negative across the board with commodities and the dollar. This hasn't changed now for a couple of days. Saw some nice little positive things at the beginning of the day because we read this from the bottom up. And then as we were falling down a little bit later, we saw some negative things happen. With oil setting a 52-week low, we have energy having a BPI below 30. And discretionary had a bearish MACD crossover. Even Canada saw a little bit of weakness right at the open. So a lot of the sectors were up, like real estate, tech was up again, and discretionary. These are more growth areas, but we're not. We need to see more follow through with this to turn more positive. Utilities still can't continue to do well. Healthcare, which is a defensive area, that's also doing well. And the big area that was down was energy, and then financials kind of got hit a bit there. And still looking okay here when we look at the S&P to equal weight S&P. We're not seeing a real divergence between the two right now. And we tick back up just a little bit with our ratio as the S&P did slightly better than the equal weight S&P. And we were down 0.25% with the Dow, but we're still above this pivot point, still above the 50-day moving average. We're going from neutral to negative with the diamonds. And we came back up, but we're still below this pivot point here with the NASDAQ, also below this pivot point with the NASDAQ 100. We've gone from being negative to neutral with the QQQs, with the Elders Impulse system. The momentum for the NASDAQ 100 is still negative, and we're still underneath this 20 and 50 period moving averages here with the QQQs. Small caps continue to decline. They were down 0.3%. They're below their 50-day moving average, but above their 200. And we continue to be negative with the small caps when looking at the Elders Impulse system. There's the Russell 2000 small caps below 50 with the RSI. That's more negative, below the 50-day moving average, and the momentum is negative. Mid caps also continuing to taper off here, down 0.18% below its 50-day moving average. Continue to be negative with the Elders Impulse system for the mid caps. And the Wilshire, this is a broad measure. It's showing some improvement here, but still below its 50-day moving average. And we're also still just slightly below its 50-day moving average with the total U.S. stock ETF. And Staples to tech ratio ticked down just a little bit, but Staples have really been outperforming more lately, and that's bringing some weakness into the market that we're seeing. We're just not seeing it reflected in the index price right now. Financial sector still looking really solid, but pulling back over 1% on Tuesday. The FANG index was up 1.5%, but still below its 50-day moving average. And we're still below this longer-term trend line here. If we can recapture that, that would be more positive. And Apple was down a little over 1/3%, dropping below its 50-day moving average. and we're coming back down. We're actually coming up here. Amazon was up 2.37%, but still below its 50-day moving average. Microsoft was up 2%, crossing back above its 200-day moving average. Google was pretty much unchanged and dropping below its 200-day moving average. Meta was unchanged on the day at its 50-day moving average. Nvidia was up 1.5% in between its 50 and 200-day moving average here. And Tesla was up 4.58% and trying to break a little bit above its 50-day moving average. Not quite there yet. Netflix was down 0.25%, still above its 50-day moving average. And seeing a stronger short-term relationship between US stocks and world stocks. Longer term, it's trailing off just a little bit here with the longer-term correlation. And we were down slightly with the dollar. We're also in a downtrend on the daily chart. Oil continues to drop. We're getting into the 65 range now. Utilities were up almost 0.5%. And this is a more defensive area. At least that's usually how we look at this. And this could be more negative for the market if it's more of a defensive type of play instead of a growth play. And staples were virtually unchanged. This is also more of a defensive area of the market, but still holding up quite well and looking pretty solid now. Healthcare was up almost 0.5% above its 50-day moving average, another defensive area. And we're watching these because these areas tend to do better when the market's getting ready to go down. We're just not really seeing that yet reflected in price. And we're declining here with the 10-year yield. It's really dropping right now, and we're going up with the 10-year based on price. I wanted to show this because this could actually be positive. The Qs to 3 to 7 year bonds, we're coming down to the 250 period moving average with this ratio. And so far, we've been bouncing up off of that. And that's what happened right at the beginning of August. That's why we're going to keep an eye on this. And when it continues to improve, that could help switch things back more positive. And we're still looking positive here with the 10 to the 2 yield curve. We're still inverted with the 10 to the 3 month, but this is still hanging on to being more normal now. And seeing a little bit of improvement, but negative here with Qs to the S&P. Discretionary is actually doing okay compared to the S&P. Turning up, but still negative when we look at large cap growth versus large cap value. So turning up, showing a little bit of improvement, but still negative with the large caps, mid caps, and small caps. And the S&P to utilities ratio continues to go down. We want this to go up to be more positive for the S&P. And we tick down a little bit, but staples have really been shooting up when we compare them to the S&P 500 here. And here's the definition of a Hindenburg Omen as it applies to stockcharts.com. And here's the chart where we do not see a confirmation, at least yet. But there's a one-day business day lag with this chart. So what's our outlook? We're still negative and we're still below support when we look at it. So yeah, even though we've been going up for 2 days, we haven't been able to switch back to a more positive stance. We're going to get the MBNA mortgage applications index and CPI. That's the big one for right now. And then the geopolitical things that could end up influencing the markets. We're going to get PPI on Thursday and then consumer credit on Friday. Here is a block around the different reports that will be coming out and then the forecasts for those. Seasonality, we do have this really in our favor. For September 11th, it's positive across the board for the Dow, S&P, and NASDAQ. And we also see some positive seasonality here when we look at September 11th. Still seems weird to say the name of that day. But when we look at what happened in 2023, Wednesday ended up being the most negative day of the week. But it's been okay, but like the worst performing day of the week, even though it's positive in 2024, where we might be coming into a little bit of time here of weak seasonality. We're coming into the 11th. We should have seen some more weakness than what we've seen, but it's the latter part of September that tends to be more seasonally weak. And we also could potentially see some weakness here if 2024 ends up playing out like 2023 ended up doing. So here's our warning signs. Now we're still keeping these on the negative side for right now, but they're improving because we're seeing kind of a mixed picture here right now with our accumulation distribution, Chaikin money flow, and Chaikin oscillator. We're keeping an eye on those defensive sectors as well. And the 5-day, it's actually turning down just a little bit, but the 10-day is still going up. Our McClellan oscillators and summation indexes for the S&P and NYSE, they are still negative. Parabolic SAR, oscillators, the money flow, the ease of movement, the Swenlin trading oscillator, the momentum and bullish percent index for the NASDAQ 100. These are all negative, including the ultimate oscillator and the Copic curve and the vortex. And we're not seeing much of a change really when we look at growth to value or discretionary to staples. Positive side, we're still looking okay with the advanced decline line, except for the small caps. The rest of the market is hanging in there pretty good. And the bullish percent indexes, even though I talked about that and seeing a little bit of a decline on an update for the S&P, they're still positive when we look at the S&P and NYSE bullish percent indexes. And the financial sector, even though it got hit, it's still looking solid overall. So what's our conclusion? We're negative. We're still below short and intermediate term support. If we continue to go up, will one of those moving averages act as overhead resistance? We're still negative, but in below the 20-period moving average in the short term, below the 50-period moving average in the intermediate term, but we're continue to be positive in the long term. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.